When we talk about money, what's the first thing that comes to mind? Probably the cash, the notes, and coins in your wallet, right? But what if I told you that's just a tiny, tiny fraction of what money actually is in our economy? Turns out the real story is way more complex and, honestly, a lot more interesting. So let's unpack it.
So let's just start with this one simple question. Is the physical cash you can hold in your hand, is that all the money there is? Well, the short answer? Absolutely not. In fact, it's just the tip of a massive iceberg.
All right, so to really get our heads around this, we've got to start at the very bottom, with the foundation of the entire system. This is what economists call reserve money.
Okay, this right here, this is like the source code of an economy's money. It's called M0, or reserve money. Think of it as the purest form of money, and it's special because it can only be created by the central bank, like the RBI in India or the Federal Reserve in the US. It's the primary ingredient from which all other money is made.
So what exactly is M0 made of? It's actually a pretty simple sum. You just take all the physical cash and coins floating around, add the money that commercial banks have to keep on deposit with the central bank, plus a few other small deposits. That's it. This is the bedrock, the monetary base for everything else.
Okay, so that's the base. Now let's build on top of that. We're getting into the kind of money you and I actually use for our day-to-day lives. This is called M1. M1 gets the nickname narrow money because it's really focused on the most liquid forms of money. And liquid, what does that even mean? It's simple, really. How fast can you spend it? M1 is the cash in your pocket and the money sitting in your checking account. It's instantly ready to go buy a coffee or pay a bill.
You can see how we're building here. To get M1, you take the currency that people like us are holding and you add what are called demand deposits. And that's just a fancy term for the money in our checking and savings accounts, the funds we can access immediately, on demand, without any delay.
But wait, we're not done yet. Not even close. M1 isn't the whole story. If you want the big picture, the one that economists and policymakers are watching like a hawk, you need to look at the broadest measure of all, M3. This is M3, or broad money, and it gives us a much, much fuller picture of what's going on. It's often called the aggregate monetary resource for a reason. It doesn't just include the money that's ready to be spent this second, but also the money that's been saved or parked for a little while.
And the math here? Super simple. You just take everything from M1, all that easily spendable cash, and you add time deposits. Things like fixed deposits or CDs, where you've locked your money away for a set period of time to earn a bit more interest.
So let's put them side by side, because this really nails the difference. M1 is all about what's available for transactions right now. M3 is about the total pool of money in the economy, including all that saved up capital. And that's exactly why M3 is always a much, much bigger number than M1.
I love this way of thinking about it. It's like a liquidity ladder. Right at the top, you've got M1, the most liquid, easy-to-spend money. As you go down the ladder to M2, M3, and even M4, you're just adding assets that are a little harder to turn into cash instantly. Now, while economists track all these steps, the really key jump to understand is from the immediate cash of M1 to the huge savings pool of M3.
Okay, hold on. We've just spent all this time defining what money is. But that brings up a way bigger and, frankly, more mind-blowing question. If the central bank only creates that tiny base layer M0, where in the world does all this other money, especially that massive amount in M3, actually come from?
Yeah, this is the real kicker. The overwhelming majority of money in our economy isn't printed by the government. Nope, it's created by commercial banks. Let's see how they do it.
Okay, just look at this diagram. It shows exactly how this magic trick works. Let's follow the money. Say someone deposits 100 rupees of that base money M0 into Bank 1. The bank has to keep a little bit of it in reserve, let's say 5 rupees, but then it lends out the other 95. Now the person who borrowed that money spends it, and it ends up being deposited in Bank 2. What does Bank 2 do? It keeps a small reserve and lends out the rest. This cycle keeps repeating, and that one single 100-rupee deposit creates a huge wave of new money flowing through the whole system.
So this incredible process we just walked through, it actually has a name, the money multiplier. It's basically the engine that lets the banking system take a small amount of that base money from the central bank and amplify it, expanding it into a much, much larger supply of broad money that we all use. And it all boils down to this really powerful formula. The total money supply out there isn't just M0. It's M0 times magnified by this money multiplier effect. This is fundamentally how a modern economy creates the credit needed for businesses to grow and for people to buy things.
All right, I know that was a lot of M0s and M3s, some definitions and processes, but why should you actually care about any of this? Well, because it has a huge, direct impact on our everyday economic lives. See, keeping an eye on these numbers is basically how central banks steer the entire economy. If M3 is growing way too fast, that could mean inflation is coming, so they might raise interest rates to cool things down. If it's growing too slow, they might cut rates to stop a recession. This isn't just abstract theory. It directly impacts the interest rate on your mortgage, your car loan, and even whether companies are hiring.
And that leaves us with one last kind of mind-bending thought to chew on. If taking out a new loan literally creates new money, what do you think happens when you pay that loan back? The answer is just as wild. The money is destroyed. It just vanishes from the money supply. Our entire financial system is constantly breathing in and out, expanding as new loans are made and contracting as old debts are settled. Something to think about. Thanks for tuning in.